Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra and this is the earnings special edition on Market Today, and our focus is on Syngene International today, the listed contract research and manufacturing services arm of Biocon that has reported its quarterly earnings, a net profit of 93.4 crores in the June quarter. That's Q1 of FY24. This is higher by 26.4% when compared to 74 crore rupees in the last year's same quarter. Now, revenue from operations have also risen 25.4% year-on-year to 808 crore rupees. The EBITDA has also seen a rise of 22.6% year-on-year to 212 crore rupees in Q1. Now, joining in to discuss the earnings fine print and the outlook on the company, I have with me Mr. Jonathan Hunt, the MD and CEO at Syngene International. Welcome to Business Today TV, sir, and thank you so much for taking the time out for this discussion. Well, the stock price has definitely given a big thumbs up to your earnings. It's touched an all-time high level today. How do you assess the Q1 earnings of your company? Have they met your own expectations? And if you could explain to our viewers what has led to the 26% growth in both your top and bottom line?
Yeah, really good quarter, I think. Absolutely in line with our internal plan, puts us on track for our full year guidance. So we guided for high teens growth on a constant currency basis. We came in at 19% constant currency, 26% reported growth on revenue, and nicely balanced actually across the business. As you know, our business really can be split into research services and development and manufacturing. And we saw growth in both of those areas. Actually, a little bit more growth in development and manufacturing, but that's a newer business for us. And that's absolutely in line with plan. And then as you drop down through the P&L, it was good to see that earnings operating leverage drop all the way through EBITDA and all the way down to PAT. So pretty much 25, 26% growth all the way down at every level. So on track, very, very good performance in the quarter, but in line with our internal expectations, right, and absolutely in line with our plan for the year.
Okay, Mr. Hunt, like you pointed out, the EBITDA margins are at around 26.2%, slightly softer than 26.8% you had clocked in a year ago. But are you comfortable with it? Do you see them improving going forward?
Yeah, I mean, the outlook is for around 30% on a full year basis. The difference between this year and last is one, it's very small. And there's an element of hedging losses going through there. So just a reflection of the degree of change you've seen principally between the US dollar and the rupee. And while we get a boost on the top line, if you think about that bridge from underlying constant currency revenue at 19 through to reported at 26, going through the cost lines, you also get a little bit of an offset on the hedging gains. But that I don't put any great store behind. So EBITDA performance for the quarter, pretty much where I expected it to be, and actually in line with where it needs to be for the full year.
Okay. Talk to us about your recent acquisitions. How has Zoetis acquisition really contributed to the company? What's the potential there in terms of the revenue contribution going forward? And second of all, tell us about the significance of the acquisition of Stelis Biopharma, the biologics manufacturing facility in Bangalore, and the growth expectations in biologics right there.
Okay, so let's just take those two bits apart, because we didn't acquire Zoetis. Zoetis is a world leader in animal health. It's a mega cap corporation, and we signed a strategic partnership with them in manufacturing last year. We've had a research relationship with them. We've been a partner of theirs for over a decade. And as those scientific programs have flown through all the way through to become products, we're now becoming also a manufacturing partner to them. That's in biologics. We signed that last year. We described it as $500 million over a decade. A simple way to think about that is around $50 million of revenue per annum. But there would be a startup phase. We're just coming through that startup phase, and that's now starting to contribute to our manufacturing strategy as quite a sizable contract. Where it links through to the Stelis acquisition is that we were running short of capacity. We'd grown very, very quickly over the last 18 months in biologics manufacturing, and we were starting to knock our heads against the ceiling of capacity. So we took the decision to bring forward what would have been an organic build that would have take us 2 or 3 years to build a new manufacturing plant. And the opportunity came up with Stelis to buy a manufacturing site from them. Good deal for them, good deal for us. It's a very nice alignment of sort of needs. They had a vaccine plant that they built for the pandemic that they didn't really need now the COVID-19 pandemic had receded, and we needed near-term capacity for expansion. And hence a sort of a coincidence of interests allows us to do that deal. It's going to take a little bit more time to operationalize it. So the deal should complete by October, and then October into the start of next year, we have to do some investment upgrades in that facility to turn it from a vaccines site manufacture to an antibody one. Very similar technologies, but not absolutely identical. So we'll put another 10 million of capex into that, and then we should be ready for validation, regulatory approvals, and operations from the beginning of next year.
Okay. Could you also give us more details on the US FDA approval for the API manufacturing plant in Mangalore, and how will this approval really impact the small molecule commercial manufacturing strategy for you?
It just adds another sort of endorsement or sort of string to your bow in terms of engaging with potential clients. One of the questions that they'll always ask is what's the standard that you built your operations to? Is it world-class regulatory standard? And it's very helpful to be able to give them the proof point that there's a product already being made there that's going into the US market, that the FDA is known to be one of the most stringent regulators in the world. And if they've endorsed your facility by reviewing it, it's a very good credential to have. So it's important, but it's no more than that. It's another endorsement that we've built a good facility. Beyond that, we now need to get out into the marketplace and build that book of business.
Okay. You've also made significant investments, like you pointed out, in the biologics manufacturing and discovery services. So what are the plans going forward to maintain a strong balance sheet and low debt profile here?
Yeah, well, I think we've captured that in the guidance that we gave. If anything, the capex exposure, the plan for the year ahead, we've reduced. We talked about that in the earnings release that we put out. So our plans for the year at the beginning of the year was $100 million of further investment across the various segments of the business. And we're reducing that down to 85 million in this year. And the reason for that is as we bring the Stelis site on board, it brings with it various of the things that we would have had to invest in anyway. Some warehousing capacity, some office space. So it brings forward the availability of capacity by 2 or 3 years, but it also just lessens the expenditure burden in the year.
Okay. What about the CDMO services business performance this quarter, and how are you planning to strengthen your position in this segment particularly?
Well, I think it's the same thing. When we talk biologics and small molecules, when we talk Stelis, biologics, Mangalore, that is the CDMO business. And we were flagging up, I think, in the commentary we made around the earnings release, really good start to the year, on track with our plans. And we're starting to see that strategic rebalancing that we said we would see, which is that the business becoming more even weight. To give you a reference point, go back to the IPO when Syngene became a public company 8 years ago. 80% plus of our revenue would be scientific research services, and quite a small part, under 20%, would have been development manufacturing. Today, that's more like 60-40 split, and I can see it getting to 50-50 in the next couple of years. So we're becoming a twin engine business rather than just a single.
That's wonderful to understand. Now, what are the investment plans and any new segments that you would want to explore going forward?
No, I think it's in line with what we laid out at the beginning of the year. So more investment in research. That's why we bought the land in Hyderabad. That gives that many years of growth capacity. More investment in the manufacturing side of the business. Major acquisition with the Stelis acquisition. That gives us many years of headroom for growth. And then the endorsement of the Mangalore site. So those three elements of the business all took a step forward this quarter.
Okay, lastly, Mr. Hunt, if you could share with us your own growth guidance for financial year 2024, any particular targets that you as a company have set for yourself, and what is your vision now for the company going
Yeah.
forward?
High teens growth on revenue on a constant currency basis. As you saw in the first quarter, we did high teens, 19% on constant currency, 26% reported. So we got an extra benefit from the rupee depreciation versus the US dollar. EBITDA margins around 30%, so up from the 26% we saw in this quarter, and PAT growth in the mid-teens.
All right. Well, pleasure speaking to you, Mr. Hunt, and getting all those insights about the company. All the very best for the coming quarters as well. And here's hoping to see you in the next quarterly earnings and understand more about the business going forward.
Pleasure.
Thank you so much, sir.
Thank you.
All right, and with that, we wrap up this special edition on the earnings focus. Syngene definitely inching higher in trade after stellar quarterly earnings. So the stock prices are hovering around the all-time high levels right now. We'll continue to watch out more about the markets going forward. So stay with us on Business Today TV, and don't forget to subscribe to this channel. You can continue to engage with us on our other social media platforms as well. Until then, many thanks for tuning in.
If you like the video, do like, comment, share and subscribe.